Well, this week we're reviewing the RCM Global Flexible Fund. Just taking a look at managers there. You've got Daniel Milan, Piet Viljoen, Willem Herzog and Paul Witburn. Fund size there, 1.4 billion rand. Inception date back in April 2003. The TER sitting at 1.31% and objective CPI plus 8%. So Linda, of course, I'll start off with you and just talk to us about the objective, how this fund is run, and talk to us about the risk measures you talk about there, the objective there of also capital preservation, or I suppose on the worse than that is losing money.
Yes, this Global Flexible Fund, it's actually, we could call it our best ideas fund, if you like. It is an absolute return-oriented fund, as all our funds really are, being absolute value investors, and hence the CPI plus 8% benchmark. And we were speaking about opportunity set. This fund has a very large opportunity set. Effectively, we can invest locally, globally, in any asset class. So really, the world is our oyster in terms of finding those undervalued opportunities. And that opportunity set has allowed us to do that. It's delivered, close to 10% above inflation since inception, as you say, all those years ago.
So we've got the numbers. We can run through the returns we've seen.
Yeah, let's just have a look quickly at the returns here. Over the last year, the return for the fund is at 11.2% versus a benchmark of 13.6. If you have a look there, the 3-year number 10.7 versus 13.1, and there you can see the inception number 15.4 versus 13.7. Remember, the benchmark here is CPI plus 8 in both in local kind of currency terms. So just to kind of add to that, let me just quickly show you what returns have looked like for the fund. And these are now rolling 12-month returns. You can see the rolling 12-month returns over here. That's now stripping out CPI plus 8. And you can see that it stays above kind of the CPI plus 8 number quite, over time. And you can see what CPI plus 8 has actually done over time. So quite frankly, it's kept above CPI plus 8. But Linda, there must be an internal measure you guys use here as well, as far as a benchmark is concerned, or is it only the absolute number? Is there a market relative index that you guys utilize as well?
No, we don't use a market relative index because it is a balanced fund. And as I say, what we're really trying to do is generate real returns above inflation for investors. The problem with the market related index is that markets do go down. So you can actually beat the market and your peers and still not deliver real returns. And ultimately, we feel most investors, they're really coming to us asking for real returns over time. And please, whatever you do, don't lose my capital. So protect it against capital loss. Mm-hmm. But having said that, our investors do come to us and they say, well, the all share has done 25% over the last year. What's going on? You guys are lagging. And it comes down to our philosophy and what's happened in the market over the last year. So as I mentioned, we're absolute value managers, and we will never buy a stock that is trading above what we believe it's worth. Doing that, we believe, exposes your investor to the risk of capital loss. Because you don't know how long that'll last, and there will be a correction at some point in time, you just don't know when. So that absolute value focus has meant that we've tended to invest in some of the resource stocks, platinum stocks, some interesting European stocks, but in the local market, those stocks have not performed over the last year. So they were cheap, they've actually become even cheaper. And the stocks that have performed over the last year, by and large, which make up that 25% in the all share, are the stocks like the retail stocks, which have delivered good performance, but have gone from expensive to even more expensive. And some of those are trading at all-time highs, lots of foreign ownership, buying expensive stocks, hoping they'll become even more expensive. We call that the greater fool theory. It's dependent on you finding a fool greater than yourself who will pay even higher price than what it's worth in what you did. So that's where the lag comes into play, that focus on protecting capital and sticking to the game plan of generating real returns over time.
I suppose, that's why, as you were saying, you've got that large weighting towards resources right now, perhaps moving also more offshore where there's some depressed valuations. So Roland, what stands out for you here? Talked about the offshore exposure, talked about the resource exposure, and seems very heavy focus on capital preservation.
Yeah, there's nothing wrong with capital preservation. I think CPI plus 8 is certainly a return we all would like. I hope it is not too challenging in the sense that, at least in the South African context, we have slowing growth and maybe increasing inflation. And I guess taking money offshore makes more sense if there isn't really anything happening domestically. You also get a bit of a yield pickup by taking your money offshore. The rand depreciates by 2 to 5% per annum over the long run, so you can actually get that kind of lock-in as well. Linda, how keen are you on the SA market, given the sort of slow political and economic and fundamental news versus the European side of things or global side of things?
Well, locally we are, which I could not say actually sort of a year and a half ago, we are now seeing some fantastic value opportunities. But typically what we think is good value, other people think is a bad idea. So what are we investing in? The stuff that's cheap. Why is it cheap? There's bad news around. So you can imagine those are the things like Amplats, Anglo-American, a lot of the resource stocks on that side, some of the gaming stocks, such as Sun International. Fantastic small cap opportunity that we've invested in is Grand Parade, which has Grand West just on the small cap size issue. But the interesting thing is that we talk about growth and macro variables and how this is going to influence our investment returns. But actually, we at ReCM feel that that's somewhat missing the point. Let me give you a good example. A year ago, I was on similar programs talking about the fact that we'd bought Titan Cement, which is a Greek cement producer, and Coca-Cola Hellenic Bottlers, which is listed in Greece, an independent Coca-Cola bottler. And we'd invested in Carrefour, which is a French retailer. Now, as you can imagine, at the time, there was maximum pessimism about the outlook on the economic side, and that continues to be the case. But the thing is, investment returns aren't driven really by what happens in markets. They're driven about what the market expects to happen versus what actually ends up happening. At the beginning of last year, prices in Europe, prices for the Greek stocks were very low because expectations were so low. Now, it might surprise you to hear that a stock like Carrefour has delivered 26% in US dollar terms over the last year, despite all the European retail woes. In local terms, that's closer to 37%. The Greek stocks have delivered 40, 50, 60%. And it all comes down to the price you pay relative to expectations.